Ideally, you should put your wealth in something which cannot be managed, which can't be changed, because you should prefer hard currencies. The Bitcoin standard.
Yeah. Have you seen it?
I've seen your photo posting it, but I didn't read it. The big question that banks have is, do we want this business, this deposit? No, because it's going to cost us. After the financial crisis, the capital requirement ratios of banks increased. So everything is against banks. I'm Grech, and I'm an accountant by profession. I got interested in Bitcoin quite late in the day. I remember a colleague mentioning it in 2009, but I thought this is it's too volatile, it must be a fad. And I think a year ago probably I got very interested in it. I got a few books, I read them, and I realized that it's not a fad. It's something big. It will change the way we do things. At the time, my friend mentioned Bitcoin. I was trading in Forex, and I did badly. So I lost all my capital. I had 2,000 euros in my account. I lost it all. And if I had at least bought a few Bitcoin at the time, which was maybe $50, $75, and I left it there, I would have been very rich, right? Yeah. So unfortunately, I was trading the wrong pair. I should have traded Bitcoin and left it there. But with hindsight, right, everyone is very, very wealthy. So really and truly, very few people are passionate about debiting and crediting, right? But it's the basis on which you build a career in the industry that you're interested in. I have a strong interest in taxation, income tax and VAT, and that's where I started off my career at PwC. And then I moved to banking, and I did quite a lot of things in banking. I started off in management accounts. I took care of the tax regime that applies to the bank. We had US withholding tax issues, and it was quite a complicated job. And then I moved to strategy. So we used to analyze whether we should go into this product or not, whether we should expand in this area, in this country or not. We used to look at, for example, what's the typical savings rate of that country? Are they tax savvy, because we wanted to be an online bank there. So we did this interesting analysis. We used to present it to the board, and we used to make a decision where to go. I then moved to project management. It was a 2-year fling. I was responsible for delivering the projects of the bank, so I saw the operations of the bank, how they work, the payment system of the bank. And then at the end, I worked in regulatory. So I led a team of 5 people. We used to submit capital ratios of the bank, liquidity ratios, all the other ratios that the bank has to adhere to. And we used to submit that to the ECB. This year I decided to quit my job, and I went solo basically. And I would like to explore, right, different avenues, see where it goes. So you said capital gain, but really and truly taxation. So let's forget crypto for now, right? Let's say you like old furniture, okay? And you bought a number of pieces of furniture, and after 10 years or after 2 years you decided to sell them because, who knows, you stopped liking it. That's a capital gain. If on the other hand you're actively trading in furniture, in old furniture, buying and selling, speculating, then it becomes trading. So that's the first distinction you have to make. Because then you have to see whether it's taxable, a taxable capital gain, or not. All trading gains are taxable. So if you're speculating, then it's taxable, no doubt about it. And likewise, if you're speculating in Bitcoin, it should be taxed. All right. Then if you believe you've made a capital gain in furniture, you look at whether it's taxable in terms of the Income Tax Act, which is not, so you don't pay tax on it. Likewise with capital gains on crypto, I believe that it should fall within the scope of Article 5 of the Income Tax Act, and therefore it should be taxable. So the short answer is yes, it's taxable, and it doesn't really matter whether you've been trading in it or whether it's a capital gain.
And what is the capital gain tax amount on things?
So if you are a company, it's 35%, right? And if you are a foreign-based, if the company is owned by foreigners, then you get a tax rebate on that. If you are an individual, you pay tax rates at the progressive rates of tax. So the first 10,000 euros is exempt, then at 15%, and so on. And the bands change depending on whether you're single, married, or have kids. If you didn't have the intention to make a profit, then it's probably a capital gain. I think that the banks, as we know it, will become broken down, right? So the historical banks used to do everything: retail, commercial, investment banking, large organizations. But as we're seeing that many micro banks are taking a piece of the pie of the big banks, of the traditional large banks, and probably in the future we will end up with a lot of small, relatively small market participants, which together make what the current bank is made up of right now. So you'd have the Revolut of this world, which takes care of the payment part. There would be maybe another part which takes care of the lending and borrowing, right? You'd have another part which takes care of the investments, maybe. Right now you walk into a bank and they try to sell you everything, right? Loans, investments, deposits, anything. Probably it will break down into more smaller parts. That's my take. I don't think it will get decentralized, to be honest. I think many people are scared of losing their money, right? Losing their crypto keys, their private keys. And we've seen a lot of theft in Bitcoin. And I think people can't trust themselves, and they want a central authority to make sure that if something happens, they can always pop in, show their ID card, and get access to their money. And if they die and their private keys are locked somewhere, their kids can take over. I don't think decentralization of money will take over, at least with the current regime. Maybe new technology comes along and it makes lots of sense. So you have to ask yourself, why do banks not allow crypto, right? That's because they don't know the source of wealth. But they should know that now there is software which tells you whether that coins are clean coins or dirty coins. So if that coin went through a mixer, through an exchange which has very poor KYC rules, if it came out of a Bitcoin wallet which appeared on the dark web or some ransomware websites, that website would know that is dirty money, don't touch it. But then that same website would know that, for example, that coin was earned by mining, and therefore it should be theoretically clean money. And that software therefore should give a good indication to banks whether the source of wealth is clean or not. And other banks are doing this. So there's Liechtenstein, which after an enhanced due diligence process advises you what to do with your crypto wealth. So if they're doing it and they have to abide with EU regulations because they're part of the EEA, then why shouldn't a Maltese bank do that? On the other hand, I also understand the bank's perspective, and I used to work in a bank. So right now, getting deposits is a cost, right? If you don't have enough capital, or if you have a given amount of capital, and now and you're maxing out that capital because you need capital to lend money. So you need deposits, together with capital, you lend that money. Say you've maxed the amount of capital that you have, and someone comes with a 1 million Bitcoin deposit. What are you going to do with that money? Say he's going to convert it to fiat. You can't actually use it. The only thing you can do is to put it with the European Central Bank and pay 40 basis points to deposit it there, overnight. So the question then starts, the big question that banks have is, do we want this business, this deposit? No, because it's going to cost us. And if the client is going to make a transaction every month, then we won't get any transaction income from him. So don't bother. Why should I go in the hassle of getting extra deposits when I can't really use it? And this came along because after the financial crisis, the capital requirement ratios of banks increased, probably doubled. So, for banks, it became very hard to raise capital because the requirements became harder, therefore the profitability decreased. Even in a low interest environment, banks also suffer from a margin point of view. So everything is against banks. So they're not allowed, so they're finding it very hard to raise capital. So limited capital, you can't raise capital. Someone comes with a risky deposit, you don't want it. Why should you bother? And I understand it's very frustrating from everyone's point of view, but after all, these are rational beings, right? Banks, they're trying to maximize profits in a very hard business environment. I know it. I've been there for 7 years. It's really difficult to run a bank nowadays. The requirements that are being imposed by the European Commission are very, very, very onerous. And so they become very choosy, right? And that's why they start shutting doors to many clients, because why should they bother?